Muy buenas tardes y bienvenidos al lanzamiento del reporte Lidiar con la deuda.
Good afternoon and welcome to this report dealing with a debt-less risk for more growth in Latin America and the Caribbean. It's a pleasure to begin with the opening statement by Ilan Goldfein, the president of the IDB, and then we will hear from Eric Parrado, chief economist and manager of the research department of the IDB. And after that, we will have the presentation of the report by its authors, and at the end we will have a top-of-the-line panel with distinguished speakers to discuss the report. It will be broadcast in English, Spanish, and Portuguese over the social media. If you want to select the language, we will place the channel for the different languages in the event.
Please look out for the links we will place in the chat to connect to that language. Adelante, Presidente Goldfein.
Buenas tardes. Es un placer estar acá con todos, tantas.
Good afternoon. It's a pleasure to be with you with so many known faces, friends who've been friends for a long time, and those we just met recently. This is the launch of the
En las Américas.
report of the IDB, Development in the Americas, dealing with a debt-less risk for more growth in Latin America and the Caribbean.
Quiero saludar especialmente
I would like to greet especially our friends and colleagues,
Liliana,
Mauricio, Eric, Susana, Andrew, and Oscar, who are part of this distinguished panel who's with us today. This book took 2 years to prepare the book. It might seem something new, but ever since I arrived here, no, that is not the case. It takes 2 years to prepare this book. And I come from the academic sector where credit is where credit is due. So the credit is due to Eric. They spent 2 years working on that and the entire IDB before my arrival. The book analyzes in depth a very important issue, which is debt and governments. But it also analyzes the debt of corporations, of businesses, and households. And it is more than a diagnostic tool, because we always say, no, the debt is high or low, what is happening? But the next point is what to do with this, and the book offers a path to follow. It is a way of making sure that the debt will work better for the benefit of our economies, or for businesses as well, and for households, for families. The debt might be useful for many things. It is not bad. A debt enables entrepreneurs to use that debt in order to create employment, because they will invest and they will want to bring employment to the people, and people use it in order to acquire goods and assets, houses, for example. This is needed to do that. Governments can also put it to a good use in order to build infrastructure. A lot of the things that we do here, bridges, schools, and more recently, the emphasis on digitalization, digital infrastructure, all of that is a midterm or longer-term project that needs a debt. And so debt is not bad in itself. However, if it is used unwisely or not carefully, the debt poses problems. It might represent a burden for the economies. It might represent a greater burden on companies, on businesses, and why not say so in our lives if we exaggerate the debt? And I must say this has triggered all over the world. It's grown in the world because it represents 2.5 times the global economic production or output in the world. And you will not be surprised when I say that Latin America and the Caribbean is no exception. Many believe that COVID made a difference, but even before COVID, the debt was already rising in the region. And I must say this, it was already halting growth. And it had already been pushed up because of the commodity prices. And the debt in the region nowadays is 5.8 billion. That is to say 117% of the regional GDP. So this figure might be lower in some advanced countries. You will hear the example of Japan or other countries, but it continues to be an obstacle to growth, and it brings up with it risk, particularly with countries with less diversified and less developed economies. Nowadays, the risks are even greater in prior periods due to the fact that we're facing a special juncture with higher rates and with more stress in the world. We are not going to overcome this challenge by resorting to words, hyperboles, exaggerating the problem and the diagnosis. But we will be helpful in thinking pragmatically about what the solutions are. What we need is an analysis based on data. When I started my statement today, I was saying that I always liked doing things evidence-based, data-based, and why can we not do it when dealing with this problem? And I was very happy when I saw that we were dealing with this based on data without exaggerating, but also without minimizing. And that is what this flagship book of the IDB is doing. The book analyzes the relevant bibliography, and it offers both original research as well as novel ideas. So this means that we don't have to start from scratch always. There are things that already exist that are available. And it is a bit what I've said during my inauguration. I said, I will come here, I will arrive, and I will listen. I don't have an answer for everything. And the book does precisely that. What is available? What do we have? Where are we? And we have to take a look at the challenges that we face. And not only that, but we have to see how we can overcome these challenges. And I'd like to highlight three recommendations that I get from the book, and I am sure that I will not do justice to the book because we always choose something. But as I said, when you don't prioritize something, you're not prioritizing anything. And so let me share with you these three things that I'd like to highlight. First, and obviously you're aware of this, we need to bring down the public debt level to more prudent levels. And as the book should suggest, we must concentrate not only in reducing the debt, but in ensuring that it be sustainable. One thing is bringing down the level, but we have to make it sustainable over time, over a longer period of time. And this will help us bring down interest rates as well as payments for interest. The risk, we would expand the necessary fiscal space in order to increase public investment. So there are consequences that will benefit everybody in this recommendation. So the book will be very clear in how to do this in a responsible way, in a way in which countries can work. And a second key recommendation has to do with guidance in order to improve institutions, and in particular fiscal institutions, but also policy frameworks. And that is something that we must do in the IDB in a general way, not only with fiscal policies. And as you will see, those who read the book, the best thing about public policies and institutions is offering governments a yield that is above a superior yield in investments. If you have a better institutions, that leads to better financial benefits, partly when raising the confidence of investors and the public. The greater the confidence I have in society and its institutions and in its public policies, including fiscal policies, then the interest rates will tend to be lower. So once again, everything is reflected in lower interest rates, in better investments, and in better growth. More confidence means investment, growth, greater fiscal revenue, so it's a virtuous cycle. The third recommendation has to do with how countries can improve the composition of a public debt. And in fact, I like that because that led me to think about my PhD thesis, where one chapter was the composition of the debt, what has to be done, how. And I doesn't have to say that it was 20, 30 years ago. So I invited Christina, and we're still talking about the composition. But I want you to know that many countries had significant progress achieved because one can say about this and nothing has happened. Well, something has happened with that composition of the public debt. And the debt, dollar-denominated debt in general, has been reduced in the region. And the maturities have been shorter. But we must also acknowledge that a lot of the progress has halted, has stopped, and that it has to continue. The book shows that governments can reduce the risks by taking advantage of the opportunities at their disposal in order to soften amortizations and lower maturities. It is not a time of crisis when you do it. You do it when you can, and we always have to think about when you can do that. The book offers a clear guidance about the best way of doing it. In summary, and I know that you're anxious, those of you who know, to hear those who know, reducing the public debt, the policy frameworks, good institutions, and good debt management are essential in order to promote investment in the private sector and to expedite social and economic development. This book offers, yes, a roadmap in order to achieve it. We must do much more in order to meet the demand of our citizens. We have to reduce poverty and inequality in several dimensions. We must find jobs and take care of inadequate health care and hunger. And for that, governments need resources for public services and for investment in infrastructure. And we will only have more resources available if we manage this debt in a prudent way. As you know, the health of the private sector in the region is essential for the future of the public sector and vice versa. So this book also analyzes the debt of the private sector, including a new database on the household debt. Besides, it offers an analysis, an innovative analysis of the importance of access to credit for SMEs. At the same time that it examines the development of balance sheets of corporations. The IDB has the privilege of having offices in each one of our member countries. And we have specialists in the region in order to assist countries to develop strategies to better manage the debt. This book will be a valuable resource in order to promote the dialogue to the extent that each country and that the government officials will look for the best path for their citizens. The IDB can assist governments in order to manage the debt. We can offer innovative products in order to assist in managing the risks related to interest rates, and setting the prices of commodities, of foreign exchange, of natural disasters. As I mentioned, adequate management of the debt can be transforming. It can enable companies to invest and to expand. It can allow governments to invest in infrastructure and to employ resources in social programs. And it can assist citizens to pay for the studies and to go up in the social and economic scale. Let me congratulate the authors for the work they've done in order to assist our people, our businesses, our countries in finding ways of building a better future. Also, I would like to commend the research department and the sector of institutions for development for the launch of this new report on development in the Americas. I wish you all a wonderful dialogue today. And with this, last but not least, let me give the floor to someone who knows, to Eric Parrado, and the panelists, to our speakers, and the moderator of the panel. Thank you, everyone, for being with us today. Thank you very much, President Goldfein, for extending that welcome to this important event for us. The day is here, so we're very happy that we're celebrating a milestone in terms of this flagship report of the bank. And I would like to welcome you for being present in our audience in person as well as virtually, and providing us the opportunity of presenting this report, which, as the president says, dealing with the debt in Latin America and the Caribbean. So we're very proud that we have this book here with us at the IDB. And there is no excuse in terms of you not being able to read it. The language is no excuse because we have one version in Spanish, another one in English, and another one in Portuguese. The report, this report, DIA, because of its acronym in English, is the tool in the Knowledge Bank, and it moderates public policy in many countries in the region, and it also adds a value to our operations. So what we try to do with this Development in the Americas report is link the analytical topic with a more operational world. And this set of research is known because of its novel findings and its strict research. And therefore, as the president said, it takes a long time. It takes as an average between 2 and 3 years. And therefore, we try to be very timely regarding an issue that is of concern to us. And the purpose is to raise awareness on a problem that might impact the economic and social development of countries in Latin America and the Caribbean. And the idea is to help governments, the private sector, to make better decisions on public policies and projects. In the last few years, this flagship publication has looked into development of skills, efficiency in public expenditure, inclusive trade integration, importance of infrastructure, and recently, confidence building in public policies. All these issues have been covered by this report, and the report we're launching today was headed by our research department together with the sector of institutions for development of the IDB and the fiscal management division in particular. And because of all of this, it is not only an effort of 2 departments, it is an effort that involved many divisions and other departments of the VP on sectors and knowledge. And I'd like to stress the role of the connectivity, markets and finance division, but it also included the VP for countries, the VP for finance and management, IDB Invest, the strategic planning office, and the risk management office. And also, obviously, with the participation of several scholars and external consultants. This is one more example of a teamwork of the IDB group. And therefore, I'd like to thank you all those who pushed and contributed so that this delegation will see the light today. And I'd like to address my special gratitude to our VP of Sectors and Knowledge, Benigno Lopez, for the constant support provided throughout the entire process in developing this report. For him as a former Minister of Finance of Paraguay, and having used these reports, DIA reports, for his own reports, it was important that we move forward with this report. This report, I believe, is extremely timely, bearing in mind the current levels of indebtedness of the public sector as well as the private sector. And in the private sector, we're talking about households as well as businesses. And our estimates suggest that the high levels of debt will be with us for several years, at least in the base scenario. Therefore, the way in which we manage these debt levels will become the determinant factor for the success of our economies in the coming decade. There is no doubt that challenges are huge for all countries in Latin America and the Caribbean. And this is taking place in a complicated global context with high inflation rates and higher financing costs. However, what we have to understand is that good debt management is essential in order to raise a good quality investment, provide better services to our citizens, to bring down financing costs, and at the end of the day, to bring about more growth and employment. In this context, the debt should not be a lag, a burden that will prevent us from bringing more well-being to our citizens. A sustainable debt has benefits that surpass costs. So the recommendation is that we must be more ambitious and to point to lower debt levels in the medium term. Obviously, the context matters, and bearing in mind what is happening in the global context and the social needs, this can be achieved gradually. What is essential is to develop, communicate a plan on what the path could be the most probable path of the fiscal policy and levels of indebtedness for the coming years. Just like the central banks provide public guidance as to where their monetary policy will be going, in the most probable scenario, governments through their Ministry of Finance and Ministries of the Economy must deliver the future guidelines of their fiscal policy. It is also important to stress, as was mentioned by the President, that the quality of the fiscal institutions matters, and it matters a lot in order to achieve this effort. Institutions such as fiscal rules anchored in the debt consistent with fiscal aggregates can reinforce a credible fiscal policy in the medium and long terms. Therefore, to improve the fiscal institutions and to reduce the levels of debt are highly complementary objectives. Although the challenges are huge, there are many ways in which progress can be made. In fact, if we do not act, the risks can increase and impact even greater our inclusive and sustainable growth protections, because they always ask about the context that it's not time for reforms. I think it is, and this is one of the main messages that the DIA report brings. And I'd like to emphasize the urgency of these recommendations, policy recommendations in the report for all countries in Latin America and the Caribbean. Now, please allow me to introduce our publishers, Oscar Valencia, who is a lead specialist in the Fiscal and Municipal Management Division, and Andrew Powell, the principal advisor in the research department. So I'd like to thank you for the effort, for the work you've done in order to successfully come to this very special day of such importance for all of us. Thank you. And after we hear Oscar and Andy, we have a wonderful panel with Liliana Rojas Suarez, Susana Cordero Guerra, and Mauricio Cárdenas, where we will review specific aspects on indebtedness in the region and economic policies that have to be implemented and how the IDB can be part of the solution with its analytical contributions as well as the operational input. So suffice it for me to thank you once again for being with us and to present our work. Without further ado, let me give the microphone to Oscar and Andrew. Good afternoon, everyone. For us, my colleague Andy Powell and Oscar Valencia, it is a huge privilege to be able to present to you today this flagship publication of the Inter-American Development Bank. And we would like to begin by thinking how we've begun working with these issues of debt at a time of crisis, and it was born during the pandemic, where what we saw is that as a bank, we needed to come up with solutions for our countries and for the well-being of our people. The main concern that we had with my colleague in starting the book was to understand the dramatic increase of the total debt, not only public debt, but also private debt. It is surprising. But in less than a decade, the debt more than doubled. It went from representing $2.7 billion to over almost 6 billion, which in English would be trillion, 2.726 trillion. And this is equivalent to 117% in terms of GDP of what is an average is produced by our region. Now, if we focus on the 5 most important economies, and the debt is even greater than. And if we establish those comparisons with the advanced economies, we can say, no, the advanced economies have an even greater indebtedness. But the main situation has to do with the payment capacity that countries have in order to sustain those levels of debt. As we can see in many studies, in emerging economies and in developing economies, as the debt rises, the payment capacity is more complex and it makes it more vulnerable when facing economic fluctuations. We have been saying this, the debt has been increasing even before the pandemic, but during the pandemic we saw a dramatic increase because countries have mobilized significant packages in order to take care of the health and economic crisis triggered and brought about by the COVID-19 pandemic. This implies that overnight the debt increases, and the main questions on which the book focuses are 3. How did the debt increase? The second question is why a high debt can become a problem. And the third one is what policy options do we have available for governments in order to reduce it? Now, the debt has been increasing substantially, and therefore governments had to face these contingencies. And for that, they used a whole set of important packages and mechanisms that enabled them to be able to consolidate the road ahead. These packages helped mitigate the economic impact, but they also pose a legacy of a greater debt in the future. So the main question is, how are we going to solve this? Why is the debt a problem? In economies where the debt is high, it becomes a burden for development. Governments have to devote more resources in order to fund the debt service. And debt servicing is a payment of interest and amortizations instead of using those resources for a better provision of public goods and be able to invest in your citizens. On the other hand, regarding investors, in a country where the debt is higher, creditors will demand higher yields for their investments. And these higher interest rates can become a disincentive for private investment and therefore for growth. The problem is that we have less space where countries can maneuver, and they're more vulnerable when faced with shocks that can come in the future.
The current situation is even more complicated. We're not even out of the pandemic when the war in Ukraine led to a greater uncertainty, an increase in prices of food, of fuel, tighter policy, monetary policy, and global rates that became higher. It was necessary to navigate in these circumstances. This resulted in greater uncertainty, and it also affected the appetite of investors looking at developing nations. When the financial situation was tighter, it was a matter of seeing whether this complements the fiscal prospects and how it affects future-looking economic prospects. This also reduces the maneuver room. As we've seen during pandemic, the maneuver possibility in the fiscal area was crucial. Now, the monetary policy plays a crucial role, and it is adapted in order to contain the effects on prices. There are also risks in inaction. If nothing is done, given the shocks that are occurring, this can then make us become even more vulnerable. The good news, however, is that we do have things that we can do, and there are policies that can be implemented to reduce these vulnerabilities. In the report, we began characterizing the episodes of debt acceleration. These episodes of debt acceleration that we can see on the screen, what can we learn from them? Well, first, they occur in bad times, times when there is an economic slowdown, high inflation rates, important depreciation in exchange rates. And something that's very interesting we found is there are also hidden liabilities among governments that can explain to a large extent the substantial debt increases. We can also see on this graph that there are reductions. However, these reductions are less frequent than the sudden increases due to the debt acceleration. Now, what happens in the bad times? Well, the debt increases in order to finance quality investment and also to generate resources for the most vulnerable population. However, and as shown in different regional studies, there are major gaps here. Investment has not always been efficient. There are challenges that need to be tackled, both for the selection, implementation, and execution of investment projects, and there's also a pressing need to better target the vulnerable populations and assist them. Furthermore, the appearance of hidden liabilities shows that we need a more solid fiscal control. The pattern of debt increase is one of the first indications that shows that we need to strengthen our fiscal institutions. What does this mean? Better public investment frames, better social networks for our citizens so that poor households may receive automatic assistance when needed, and do not have to depend on the discretional programs at the time. We also need institutions that can better monitor and manage public debt and ensure that, although the debt is increasing at bad times, this should be passing and can be reduced in future times. However, the problem that we're facing currently is a high debt. The billion-dollar questions are, is the debt level currently sustainable? Is it desirable? And if not, what should we be doing? Countries are already taking action. The most recent statistics show that countries have been correcting their fiscal balance sheets, and they are withdrawing the pandemic stimulus programs, and baseline projections in the bank show that slowly the debt is being reduced for the medium term. But this is far from what we faced pre-pandemic. Furthermore, our analysis shows that historically, to think about fiscal stress periods, debt has been sustainable. Obviously, there are differences between countries, but nonetheless, this doesn't ensure that sustainability will maintain over time and that there will not be any risks that can jeopardize sustainability. In the flagship report, we sustain that the region should be more energetic, not only thinking about sustainability, but also prudence. We even propose that the debt ought to be reduced to levels lower than what the initial scenario suggests. Well, prudence means a prudent debt level is that in which countries may adapt without being substantially impacted by the normal risks. These could be market risks or even climate change risks. In the document, we present estimates by groups of countries, and the methodologies are actually applicable to any of the countries in the region. Our estimates suggest that the prudent average range for Latin America would be between 46 and 55% of GDP. Obviously, this will require a greater effort, but how much effort? Here again, we provide calculations about the necessary fiscal effort, which has accounts for about 1.4% additional GDP on average. Let me give you an order of magnitude. A fiscal reform, that is to say, an increase in tax, reduction in average spending, will result in an average of 1% for the region. This means that to achieve the prudent level, we are talking about a reform. How to implement this? Well, implementation is crucial. Obviously, we have spoken about the yield generated by reforms, but the efficiency is key. My colleague Andy Powell will be presenting details showing how policies seeking efficiency in the spending and taxes will help us meet this challenge. Another fundamental topic is a legacy from the pandemic also, is that inequality has increased. So here also it is necessary to have tax and transfer programs that are progressive to decrease inequality. Better fiscal institutions will allow us to sustain lower debt levels that are less onerous and especially more prudent. That is the second reason why we need better fiscal institutions. One of the key institutions in the region are the fiscal rules. Less than half of the countries in the region have such rules. But it's not enough to just have fiscal rules. Quality matters. In our report, we show how fiscal rules developed with quality reduce the probability of debt acceleration. This is a great opportunity for us as a bank to interact with countries because during the pandemic, most countries suspended their fiscal rules and currently they are recalibrating them. One of the tasks that we do here at the IDB is help countries in the recalibration processes. But another group of countries that do not have such fiscal rules face the challenge of generating the right institutional framework so that they can have successful fiscal consolidations and that debt doesn't become a risk for them. We speak about quality. What ingredients are needed for a quality fiscal rule? We're talking about solid legal basis. We're also talking about surveillance mechanisms, credible compliance, flexibility to adapt to shocks, escape clauses, and an independent fiscal council or board. With regards to this latter idea, we believe these boards are tremendously valuable to maximize the yield of the existing fiscal regulations. Thus far, we have argued that to reduce interest rates, to reduce debt burden, generates space for a greater delivery of public goods. But that's not all. It also minimizes risk, and this has important implications for growth. In regard to this, we present evidence that over and above a level of 60% of debt to GDP in the region, growth could be slowing down our economies. Nonetheless, if we take into account the quality of institutions, this effect of over-indebtedness on growth could be softened. To maintain the situation in the prudent spectrum promotes growth furthermore because it makes it possible to generate resources in order to progress faster and not to be compromised when it comes to risk. Lastly, the challenge we face is to avoid falling in the slow growth trap with greater poverty. If we focus on generating policies converging towards prudent debt levels and that are coherent, credible frameworks in the medium term, then we can understand that it will be possible to generate a balance between policies for sustainable growth and that the debt does not become an element that slows growth. Let me now hand over to Andy Powell, who will continue with this discussion. Good afternoon to everyone. It is a pleasure to be with you. I'm Andy Powell, and I will be presenting the second half of this talk, talking first about how we can reduce debt. That's an easy question to answer, right? Well, there are different ways, many different ways, no single formula. The best path is built based on each country's characteristics. For instance, countries with high fiscal income and high spending levels can opt for a path focusing essentially on improving efficiency. Oscar has already referred to efficiency. In prior IDB estimates, it was calculated that there are at least 4% of GDP in potential gains to be achieved merely on the spending side. And this was just an average. So if we now think, after the pandemic, with higher spending levels, thinking also about spending and tax, and thinking also about those countries with higher spending and tax levels, then the potential gains are probably much higher than the estimated figure. On the other hand, those countries with lower tax collection levels could think about other means, such as expanding the tax base. It would also be very important to improve public investment frameworks. If spending quality is sufficiently good, an increase in collections together with more public investment is a win-win situation. It can increase growth while, according to prior estimates, reducing poverty. In the book, a lot more detail is provided about the different alternatives as to which are the best policies depending on each country's characteristics. Thus far, we have been speaking about debt levels, but the debt composition is as important as its level. The choice of an optimum composition is a very complex problem with lots of decisions and trade-offs to be made. But if we look at recent history, the region has improved considerably in management and debt composition, as Ilan mentioned. The debt denominated dollar-denominated debt has reduced, as well as the short-term debt in terms or compared to the overall debt. But these advances have become stagnant. For instance, if we look at this graph of debt maturities, you can see the improvement. But then, in both categories, in the national currency and foreign currency debt, and the maturities in recent years have dropped. If we have a forward-looking vision with the current debt structure, there are 13 countries that will be facing GDP, 2% of GDP for debt servicing in the coming years, and 7 of these countries have debt servicing that is over 5% of their GDP. If we compare this to public investment in infrastructure, it's about 2.5% right now. So these are significant figures. The book analyzes all the trade-offs, the facts, what has actually occurred, and how debt composition can be enhanced. In the medium term, developing local capital markets that are deeper. This can provide more alternatives, such as the possibility of issuing more debt in local currency. Multilateral development banks, such as the IDB, can also help manage debt. Multilateral banks provide long-term debts at competitive rates. They offer guarantees. They also offer other instruments to manage risk, the interest rate risk, the commodity price risk, the financial risk due to natural disasters, etc. The region ought to take advantage of all available instruments. It is important to point out that we have seen successes in successful debt reductions, for instance, in the region. We have the examples of Brazil, Colombia, Jamaica, Peru, Trinidad and Tobago. All have managed to have significant debt reduction through growth and fiscal consolidation. However, we also find that there were more episodes of debt reduction with high inflation, inflation being the way of reducing debt. That's nothing new, but what is novel is that looking at these episodes in greater depth, these are not high inflations. It's rather a moderate inflation with independent central banks and well-anchored expectations. So the election in the current situation is to add another reason to maintain solid monetary systems with independent central banks and well-anchored expectations. However, in certain cases, debt has become unsustainable. And as last resort, there are countries that have restructured their debt. The region has been placed at the heart of innovations and techniques for debt restructuring starting in the 80s. This innovation continues and can be observed in the 5 debt restructuring pieces since the year 2020. However, there are some older topics and there are some new challenges. No country wants to restructure its debt, however. But if it becomes necessary, it is very important that they have an efficient process able to truly address the problems that are underlying the situation. So in order to look at these old and new problems, we should recommend creating a regional forum to complement current international efforts that were more centered on low-income countries. Thus far, in our presentation, we have been talking about public debt. However, private debt has also increased. In general, our financial systems are larger than before. 1/4 of the countries have domestic credit of at least 100% of GDP. But then 1/4 of the countries in the region have loans that account for less than 50% of GDP. So this is work in progress. What this means is that there are some areas where loans for households and loans to, in particular, the SMEs, small and medium enterprises, remains scant. To take a deeper look into household loans, we have worked with central banks throughout the region, and we developed a new database focusing on loans to families with broad coverage in the region. We can see that household loans have grown, yes, but in general terms, the level is low when we compare it to normal international parameters. It would therefore be important to continue working to ensure that households have greater access to loans, but at the same time, it would be important for central banks and consumer protection agencies continue monitoring this progress. Now, on the other hand, almost 25% of SMEs still indicate that limitations to access credit is a leading problem for them. In a very novel study based on Central American data, we find that access to credit was a crucial factor for the survival of SMEs during the pandemic. So the lesson is that access to credit is not only important for growth of the enterprise, but also for enterprises to be able to overcome the important negative shocks. Now, what happens with the larger companies? The larger companies are in a very different situation. They had good access to credit, and their debt levels had already increased prior to the pandemic. They took advantage of the very low interest rates at the time, of course. But then with the crisis, they borrowed even more in order to accumulate liquidity. And thanks to this, we're able to survive the crisis. Presently, the debt has once again returned to its pre-pandemic levels, but the fixed assets have decreased due to lack of investment. So large corporations or companies today face a combination of greater risk because of what's happening in the world, but also with low fixed assets and relatively high debt. So the question is, are they in a good position to rebuild their productive capital? And the problem is that this could actually slow down growth. As countries reduce the large guarantee systems that maintained credit flows during the pandemic, the interesting question will be, are there other useful policies that can support the enterprises in this post-pandemic phase without significant fiscal costs, but nonetheless able to help rebuild productive capital? We recommend thinking broader offer of instruments, but also a more selective election for the companies. The book has many recommendations, but I would like to conclude by focusing on 5 ideas. These are key recommendations. The first is, or the first priority would be to improve fiscal institutions. Then we'll be less dependent on discretional fiscal policies and more those that are automatically established, to have better fiscal planning in the medium term and independent valuations looking at the impact of different measures, and to have more credible and exact indications. In English, we would call that fiscal guidance. Better fiscal institutions do not imply a significant financial cost. They don't need an investment that is significant today, but they can reduce risk, increase interest rates, increase trust, and allow the region then to live with today's level of indebtedness. Second, we recommend considering fiscal consolidation that goes beyond current plans. There are many paths to achieve this goal, and the well-designed policy programs can increase growth, but also favor the most vulnerable households. Fiscal consolidation can provide space for greater public investment, promoting growth. Third, improve debt management. There are opportunities to reduce risk, extending maturities and avoiding a concentration of amortization. The IDB and other multilaterals can help in this. Fourth, we need to rethink more effective ways to help companies, enterprises. What we need is well-targeted help for those entities that truly need support and when they are promising, but with a broader set of financial instruments. Lastly, 5, we recommend creation of a regional forum to complement the international financial architecture that exists today. This can mobilize the vast knowledge and experience in the region. And among other topics that are important, the forum can also discuss, for instance, the super interesting question, which I think is extremely important, whether it would be possible and how to link debt challenges with climate challenges and the transition towards green economies. This at the same time will also require important and significant investments. This presentation is just a little sample of what is actually contained in the report. The information in this book goes into much greater detail. The report is based on original investigation that you will find on the website shown on the screen. So, in conclusion, let me once again thank all those who were involved in one way or another. Lots of people participated in this project. We would like to once again thank all of those individuals who were involved, who contributed, and we hope this book will be useful to you all, and I thank you for your attention. Thank you so much, Andy and Oscar, for this presentation. And as Andy pointed out, this is simply an entree as to the contents of the book. I invite you to download the book. It's already accessible on our webpage, and it would be very important for you to download it to look at all the details about the recommendations, not only the background also and the diagnosis that the book contains, but also looking at the policies we are recommending. We're now going to have a panel. We already have 3 panelists with us. These are friends of the bank. 2 are in the bank and 1 is present. So we're very happy to have these panelists. Liliana Rojas Suarez is with us from Lima, Peru. Presumably you're enjoying good food there, but we're very grateful for you joining us virtually. Mauricio and Susana are here in person. There's no need to present them, to introduce them. Let me just refer to their positions today. Liliana is Director for the Latin American Initiative and Chief Member for the Global Development Center and President of the Latin American Committee of Macroeconomic and Financial Matters and adjunct professor at Columbia University. Mauricio is a professor at the International and Public Affairs Department of Columbia and is in charge of Public Administration Masters with a global. So this is yet another competitor to these MBAs. And in the case of Susana Cordeiro Guerra, she, as you know, is the manager of the institution's development of the IDB. Thank you very much for joining us on this panel this afternoon. The rules of the game are the following. Liliana and Mauricio will have 10 minutes each to share their views of the report, what they think about the recommendations contained in the same, and how useful it can be for our governments. And then Susana will talk about how joining these 2 worlds, the analytic world of investigation and the world of operations. Now, what do we tell our governments and our private sector? What do we recommend that they do to manage the debt? Liliana, you have the floor. Thank you very much for this invitation. And I must say my first comment is, of course, congratulations to the book authors. It is truly fantastic. It is a combination, a very rich gathered compilation of data complemented by a deep evaluation of the magnitude of debt problems, and they propose important policy recommendations. As we don't have much time, let me focus on a couple of points and make a suggestion. First, a comment as to the future evolution of indebtedness in Latin America. I have a question. In the report, it clearly says, and I asked myself, that the debt levels in the region are quite high. The question is, can this debt accumulation process be reverted? In other words, the strong period of debt accumulations occurred in a time of cheap funding, where investors internationally were willing to assume risk, sometimes excessive risk, in trying to reap the profits. The report says indebtedness grew enormously during COVID because the public and private sector needed funding in order to survive the pandemic.
The fear that has been expressed in a series of recent projections for 2023 is that during the current time of the post-pandemic, but with high levels of inflation that are still very high, and particularly the increases in the interest rate, the Federal Reserve, the hopes of the European Bank, and the tightening of the Federal Reserve. So one wonders about these projections and these reports that are coming from the World Bank and the IMF next week, that maybe all of a sudden we could have a drop in capital income coming to the region. But what a surprise. Now we are at the beginning of 2023 and the global indicators have become positive. We have signs of a drop in inflation and the recession will not be as profound as was expected, particularly in the U.S., lifting restrictions in China because of COVID. All these positive signals have resulted in revisions, upward revisions to the growth of protection. What do we see in capital flows to emerging countries? Well, a significant increase. And just to give you an example, in a recent report from the Deutsche Bank, it has estimated that during the first 13 working days in 2023, the placement of government bonds of emerging countries have reached 45% of the entire issuance that was done in 2022. 2022 is a low base, but even with that, the point is that we could even observe a greater depth in the debt problem before its resolution. So this means that the debt ratios could include even more, and not only due to a projected drop in economic activity in the region, but also due to an increase in the value of the debt. An additional point to this comment is that the rules of operation in international markets have lagged behind. They're sort of short. There are many rules for the behavior of banks, but not for non-banking financial institutions. So we're faced with a situation in which it is possible that now once again we can turn this optimism into one more point, because the resolution has not caught up the banks with the rest of the stakeholders in capital markets, that at least those who offer debt will increase or raise their purchase of these new issuance that governments can bring out, and even worsen more the situation than what we have now. My second comment has to do with the discussion in the report on the quality of fiscal institutions as a determinant for an adequate analysis on debt sustainability. I really like the discussion in Chapter 5 on the debt dynamics and the importance in the fiscal response in order to correct an excessive indebtedness. The report clearly points out that a high level of debt can perfectly be sustainable if there's confidence in saying that the fiscal response will be adequate, but it could be completely unsustainable if we do not expect the correct response. And also the introduction of this new concept, and it is not a new concept, but the way in which it is quantified and defined with a wise or prudent level of debt, as was clearly said in the presentation, those levels that allow the debt to be sustainable, even in the presence of adverse shocks. The report offers different methodologies, and it does an estimate of how much this level of a prudent debt would be, and it varies depending on the methodologies that we have. It went from 42 to 55% from what I read in the report, depending on the type of country we're talking about. A bit higher if countries are dependent on commodity prices versus those that have more diversified economies. Now, clearly, the current debt levels in many countries in the region surpass these debt levels that are considered as prudent. Therefore, the authors recommend, and rightly so, that in order to reduce these risks of potential crisis, especially as Andy and Oscar has said, in the context of high interest rates and perhaps shocks. And so what they recommend is for countries to have the combination of bringing down their debt levels, and what is very important, to improve the quality of fiscal institutions so that the level of debt that they can maintain without avoiding crisis could be slightly bigger. And these pieces of advice are very sound, but I have a question. How feasible are they to be attained? bearing in mind the recent weakening, institutional weakening at a comprehensive level, not only fiscal institutions in the region. And I would argue that it is not only the quality of fiscal institutions what matters, but the quality of institutionality in general, because this determines not only the capacity of governments to implement corrective fiscal policies, but the will of these to implement said policies. The World Bank has a recent analysis that allows us to classify countries based on the risk that they have in defaulting in debt. And it uses a combination of economic data and indicators of institutional quality, including but not exclusively the quality of fiscal institutions and the management, debt management. The main focus of the analysis of the World Bank is on low-income countries, and I replicated this analysis for emerging countries. I expanded the study in Latin America, does not show the deterioration of the institutional quality at a general level, not only on the fiscal side of it, in the region. And that leads me to believe that the recommendations could also include state reforms and in the legislative branch, so that the fiscal policy, the specific fiscal policies that the report recommends, can be implemented. Another additional comment will have to do with the corporate debt in the private sector. And that discussion was excellent. And I was very glad to see that an important part of the assessment of the behavior of major corporations, and one of the suggestions are similar to other reports that the IDB has together with the Center for Global Development. And obviously, I'm very proud to see that these recommendations are also included in this report. And I have a comment that supplements what we already have in the report. The report points out that there's certain characteristics of the debt composition that have recently deteriorated, including an increase in the share of debt that is dollar denominated, and also an increase in short-term debt. But it seems to me that we could have a bit more discussion about the problems of mismatch of currencies of companies. And the reason I say this is because there's a few studies that show that these mismatches in corporate balances are representative, and they represent the source of vulnerability that is quite significant. In fact, currently there is a debate taking place between those who argue that big Latin American businesses have adequate coverage, that is to say they have good hedging in their debt exposures in dollars, in such a way that significant depreciations in currencies would not bring a major weakening in the balance sheet of the companies. But on the other hand, we have those who argue that these hedges are not adequate, particularly in the case of companies of not tradable, that don't have any natural hedges from exports and imports. Those who believe that the hedges of corporate businesses are adequate, we have Jose Gregorio, president of the Central Bank of Chile, and he argues the following: the region has had significant depreciations, and we have not had a huge number of corporations that have fallen into a default. On the other side, we have economists from the International Bank for Payments, including Turner from BIS, who says that if one were to divide the companies between those in the tradable sector and the non-tradable sector, these last have increased their debt in dollars in a significant way. And many of them use imperfect hedges that are fragile, such as, for example, the use of swaps, 3-month swaps, due to the fact that they're very vulnerable to liquidity pressures, and they cannot be appropriate hedges for the debt in dollars, long-term debt. So I'd like to know what the position is of IDB researchers in this debate that has been quite interesting in the region. And last but not least, my last comment is also another issue, and I'd like for you to discuss this, and it has to do with how the problems that the report has identified in the study can impact the stability of the financial system. I will not take any longer here, but it is an issue that is still pending. We know very well that the financial system, its quality has improved significantly, but it is being pushed. There's a whole set of elements that can have different impacts, and it would be interesting to discuss these. And in order to conclude, it seems to me that this is an unbelievable contribution that is being made by the research department of the IDB to the region. I believe that this will be a manual that will be used by economic policymakers in the region in order to design policies, very challenging policies that we have ahead of us. And thank you, everyone. Thank you very much, Liliana. Big round of applause for Liliana. And in 10 minutes, you gave us a keynote presentation about the debt problem in the region. So thank you very much. Maybe the messages that I could highlight is not to fall in complacency in terms of believing that things are going so well on management of public policies, particularly bearing in mind the inflationary context and the financing cost. And what is very important is what you were saying about fiscal institutions. Institutionality, total institutionality is what matters. But I would also stress the following. There are efforts in terms of having strong institutions within the region, such as central banks that are independent, that have reacted on time, and that sometimes we don't mention this much, but these are debt offices or debt management offices. We have to highlight the role played by these debt offices, giving them more autonomy, more independence, and for them to be able to work on the discussions that we've had of a composition of expenditure and composition of currencies and composition in terms of the risks that we see. And with that, I'll leave it at this, Liliana, and I will turn to Mauricio so that we can give him time for his comments. Mauricio, please. Thank you very much, Erika. Congratulations, particularly for Andy and Oscar, the two lead authors of this report, but also to the entire team, because it is very clear that this is teamwork that collects many contributions and many documents, and that this is a collective effort. So my sincere congratulations. Almost everything has been said in the presentation by the authors, the statement by the president of the IDB, and the comments by Liliana now. And I would add the following. To the relevance of this document, the importance of current moment. This document, its original motivation is linked to the significant increase that we saw with debt in Latin America, particularly public debt as a result of the pandemic. We reached a level of indebtedness of 71% of GDP in the region as a whole, and with 10 percentage points above what we had before the pandemic. And in the last few years prior to the pandemic, debt had been rising because after the drop in the price of commodities, many countries reacted with increases in the level of indebtedness. So the document is an excellent exercise in identifying those cases where we've seen sudden rapid increases in the level of indebtedness of countries in the course of history, and not only for Latin America, but for a large sample of countries. And this recent period of time is clearly an example of sudden rapid increases in the level of indebtedness. More than 50% of countries in Latin America had to face this phenomenon. And this accelerated phenomena in the level of indebtedness are a problem. Why? Because it is difficult to stop them, and they do bring devastation with them. The president of the IDB was talking about the PhD thesis, and when I read the document, I had that flashback because I had my PhD thesis done at the beginning of the 90s, and I want you to know that at that time, we didn't talk about anything different than the debt overhang, and how this was a sort of a stop to growth because high levels of indebtedness, first of all, they bring with it high costs in debt servicing, and we saw that in Latin America. We saw how Latin America is in 5% of GDP, and this is practically the same thing we spend in health and in education. So the first effect is a crowding out of resources that could be used in productive investment. Two, we see that the spreads increase, that the cost of financing increases. Liliana is quite right, saying that during the first days of this year, we've had significant significant issuing of debt in Latin American countries, but at a much higher cost. And this is linked to a significant increase in the spreads. And I will give you an example. Colombia nowadays is placing foreign debt at rates that are close to 8%, state entities such as Ecopetrol 9%, when in the times of greater global liquidity, we were placing debt at 4 or 5%. So this also has its cost, but particularly in the old literature of debt overhang, it also emphasizes that when the debt is very high, we lose the incentive to investment. This means investment comes down in general, and therefore we see a drop in economic growth. So the major question that we have to ask ourselves is there a very high level of indebtedness in Latin America? Are we going into a threshold after this last acceleration? Are we faced with a situation in which there's a debt overhang, and this will bring with it negative consequences? And I would say that the generalized response, and obviously the book is very careful in saying that each case is different, but the overall response would be yes, because although in 2022 we saw a drop in the level of indebtedness, we're still above that range, which is prudent, optimum, desirable, which is approximately 45 to 55% of GDP. So in many countries, they do have some homework to do in reducing the level of indebtedness.
And this coincides when in the world, there is not a strong concern about recession this year, about an economic crisis. That has disappeared a little bit. But now we do have the polycrisis, this combination, the food or the energy crisis, wars, the effects of climate change. No one could say that the worst is over. Something new can appear at any point in time, any one of these crises, and to react to them, then access to financing will be needed. So the best thing we can do right now is take the time to read this document and to see how then can we decrease indebtedness in Latin America. That is, I think, the valuable contributions made by the book. It talks about the successful experiences, such as when there were reductions in indebtedness, but also with the type of institutions that offset the high level of indebtedness. The optimum level of indebtedness is not an absolute concept. It depends on the institutional quality. A little bit higher indebtedness can be supported with a better quality of institutions. And I understand what Liliana says about general institutions, but in this particular case, fundamentally, it is fiscal institutions. So I'm going to focus my remaining comments on that. In addition to the level of indebtedness and the overhang, there is also a problem of composition. It comes from earlier times, but it became more serious during the pandemic. More foreign currency indebtedness creates vulnerability. We all know that foreign currency debt amplifies external shocks when there are changes in the type of exchange rate. So we need to resolve the composition and the level problem. These are two different problems that need to be addressed. With regards to the problem of composition, the first element, and there is a chapter that is devoted entirely to this topic, is the development of local or domestic bond markets. It is still surprising to see Latin American countries where the domestic or national currency component is absolutely marginal. I think the emblematic case is Paraguay. In Paraguay, there's only 1.3% of GDP in internal or domestic public debt. What does this mean? It means that most of it is external debt. So one first recommendation is to start on a long road. It's complex, no doubt about it, but it needs that first momentum, and this is the right moment to develop the national capital market. There are lots of pieces to this jigsaw, but it's a road. And perhaps we are right now in the situation where many countries, not only Paraguay, but also Guatemala and dollarized economies, where there is no significant domestic debt component in order to start on the road of developing the national market. That is fundamental. Moving now to consolidation and successful reductions. The book talks about one important case of sustainable indebtedness reduction. It's the case of Jamaica. It's based on fiscal consolidation, the generation of primary surplus. There is no alternative. There are no shortcuts to reduce indebtedness. Reduction of fiscal imbalances. So the book says, and based on a lot of work carried out by IDB and lots of evidence, that one way to do this is by ensuring that public spending is more efficient and that the tax collection system is also more efficient without having any negative consequences on economic activity and in particular on the social sectors. Efficiency begins doubly important. My suggestion here is to translate this knowledge and literature on efficiency into some indicators that countries can use to compare one another, and especially to look into the conversation of how efficient their public spending is. This can be done by sectors, and I think it's also important to have efficiency in tax administration and tax collection. Many countries have said they've made advances in this management, they're more efficient, but it's very difficult to truly evaluate them, and to have some good benchmarks for this would be very useful. As for the institutional area, there's a lot of evidence, and the book is fantastic in documenting it, how countries that better managed public debt created institutions through specialized offices or departments, generally in the Ministry of Finance, that are responsible for resolving trade-offs, tensions, and problems. So what's the optimum level, for instance, between foreign debt and national debt, between private market bond issuance or official ones, multilateral entities and bilateral entities? So there are lots and lots of questions that need to be addressed. And if there are more institutions focusing on this process to analyze the level of indebtedness, all the better. The IDB has an indicator for the quality of these offices or agencies when they exist in order to manage debt. Lastly, what should we do? With these polycrises, with all the threats, the need to reduce indebtedness, where do we begin? How do we do it? 2022 was a year that helped us because there was an inflationary shock or surprise. Now, that is good news because it reduced the level of GDP debt. However, we cannot get used to reducing debt thanks or through inflation, because in the long term, the countries that try to reduce debt through inflation, well, the solution is worse than the problem because the cost of financing increases. So it's good to say we had good news. It helps us to move towards reduction of debt when this was the inflation in 2022. However, the entire effort to reduce inflation needs to be reinforced throughout Latin America. There is a significant increase in commodity prices. Some countries were successful. When I mentioned Colombia, that focused on the beginning, the first decade of this century, they reduced their debt by taking advantage of commodity boom. And right now we're in another commodity boom. Countries ought to seize this opportunity to generate more primary excesses or surpluses and reduce their level of debt. And lastly, how do we generate these adjustments with the primary surplus? There is a comparison between shock therapy in countries that reduce debt very strongly and have an immediate benefit through reduction of financing costs, or perhaps is it better to have a softer landing or reduction? The conclusion is that the more gradual, softer, but credible decreases of loan could be better because they won't have negative impact on other indicators such as development, and they don't generate a public investment trauma, especially for social sectors. So a gradual, sustainable transition is probably the best path forward. And let me conclude by saying that something that can help harmonize matters is more intensive use of the topical or thematic bonds. The book refers to this in passing, but it is an important topic for the IDB in particular in the region also. I think through this type of bond, the bonds that are indexed based on sustainability targets will be able to finance financing and help change the composition so that these targets for reaching sustainable indebtedness become more sustainable. So there are lots and lots of ideas here. The analysis is very rich, but there's a major call to action. And this could impact the activities to be carried out by the IDB in the region, as well as on policies to be adopted by governments right now. The message is the time is now, and I end with this. It's the time to tank right now, because we don't know when we're going to face a new crisis, what it's going to be like, what will be its specific variable. But this will probably occur, and this is a region in which probably countries can take advantage of the conditions in order to build their capacity for in the future being able to obtain the financing to address the mega threats that we all have to confront. Thank you. Thank you very much, Mauricio. All your comments were also very interesting. And it's important when we talk about increasing debt, it's not only the level that matters, but also the speed of accumulation, and that's why we refer to the peaks. And the book is for all Latin American and Caribbean countries, not only those with the highest debt level, but for all the countries that have rapidly accumulated debt, because this can also have an impact when it comes to confidence in the future. So we're very grateful for all your comments. And what we're going to do with the comments from Liliana and Mauricio is try to tune our own discourse in accordance also with the book. But it's very important to combine the analysis, what we're looking at in the book, with more operational. How do we bring this book down to the level of countries? Countries are asking us, how can the IDB help us in this situation? So let me give the floor to Susana to address this problem. Thank you, Eric.
And I think he calls in a sense of urgency that we have right now in terms of all these shocks that the region is confronting, and really presents an opportunity for countries to make progress on this old challenge. And for this, it's really the bank on the first. So I'm going to go back and circle to the 3 recommendations that have been discussed along the panel. The first one is reducing debt, right? And here the IDB works through its programmatic loans, and over the past 2 years, to give you a sense of our volumes, we've committed to more than $2 billion to strengthen government's fiscal consolidation. We're improving tax revenue collection, at the same time spending efficiency. But to get at the point that Minister Cardenas was saying about finding this fiscal room, and there's no other way than improving spending. And for this, the challenge is that a lot of these countries have incredible, in the case of Brazil, for example, 90% of spending has these rigidities. So how can you really create this room given that you're in a straitjacket? And so here it really goes into Liliana's point about, this is a discussion on fiscal institutions, but it's also a discussion on the broader institutional scaffolding. And there you are going to need to have legislative changes and changes in broader policies to be able to optimize this interaction effect between both kinds of institutions. The second point that we work in very vigorously is building up the capacity of these fiscal institutions. And there we're doing a lot through technical assistance by underwriting reforms that generate this capacity, and with our broader goal to boost credibility of fiscal policy. And here goes to the discussion that was ongoing about strengthening fiscal councils, strengthening fiscal rules, and we're trying to find a way to boost this framework for sustainability across countries. And here, I have to say that what we're drawing mostly on is trying to bring inputs to the governments in terms of technical and technological tools and knowledge, so that these local governments can absorb these tools and be able to draw on this data to triage between different policy decisions in real time. So really leveraging data and technology, artificial intelligence. An example of this is our FISLAC platform, which models itself on an economist intelligence type unit that we're going to embed in all of our the ambition is to get to all of the countries, so that we can work closely with governments, so that they can absorb this technology, and the tool and data becomes a real asset in real time, so that these countries can make decisions among different types of subsidies, different types of tax reforms. And we're now working with Paraguay and Colombia. We were in real time helping Colombia in the tax administration reform implementation through this tool. And it really provides early warning signs for governments to be able to address macro fiscal shocks. And here we're moving on to thinking about resilient institutions, resilient fiscal institutions that can cope with these shocks, with these external shocks, in a very agile manner. And the bank is moving towards this dynamism and really going beyond the border of a project in a country in a given point in time, but drawing on these tools to be able to gain more capillarity at the several levels of government, going down to the local level. Our loans are going down to municipal levels, so we need to be present there as well, and this gives us this capillarity. So what have we learned so far in terms of both our loans and our technical assistance? I think we can draw two broad lessons. One, and it has been said here before, but it's this great discrepancy between the de jure policy, the de jure fiscal institution that we try to implement. We're very good at the consensus, the Washington consensus. What are the types of fiscal institutions that we need to implement, the rules that are most optimized. But then we have this huge gap in terms of the implementation capacity and how to get these, how to keep the teeth sharp of these different reforms. And that gap is very hard to address because of all these political economy constraints that have been alluded to. But the point is that sometimes it's better to have a third best option and to calibrate that option over time. And I think this speaks to the incrementalism that the minister was speaking about. And so move on to a better and better model with gradualism as opposed to having none at all. And I feel that oftentimes in these debates, we wring our hands if we don't find the perfect independent fiscal council to place at that given point in time. I think we have to work better in terms of an incrementalism and gradualism in how we approach these reforms. The other big challenge, and the conversation alluded to it, is how can we combine the decade-long concept of credibility with flexibility? And I think this has been more pronounced with the pandemic and with the shocks that we've lived in. So how can we find the sweet spot between credibility and flexibility in a way that we can adjust these fiscal institutions to be better designed so that we can cope with these shocks? And here, I think as much as we have this band in terms of the types of that Liliana mentioned and that was presented, the band of the debt levels that are optimum, we should also have bands in terms of the criteria and the parameter of these different fiscal institutions, and try to model and forecast what would be different variations of these model and the implementation of these models. And the idea that just because you have more flexibility doesn't mean that you have less accountability. In fact, you should have more, and you can get more if you have better designed parameters. Third, I want to go into the last challenge about improving debt management and the debt composition. And here, we thankfully are moving in the right direction as a bank, and I think are at the cutting edge in terms of what multilateral institutions are doing in terms of our sovereign guarantee products, in terms of the recent debt for nature swaps that we had in Barbados, in the Bahamas. And these instruments really allow us to combine development and debt management objectives with broader environmental sustainability goals. And this is really powerful in the sense of combining these objectives for regional public goods. We're protecting the Galapagos, and that really puts the IDB as a regional bank in a position to have global purpose and impact. And that's very powerful given that we are a bank in a region with the Amazon, with the Galapagos, with the Pantanal. And we can go onwards and onwards, but the idea that our goals as a region can spill over in a very targeted manner if we apply well these instruments, I think can be very potent in this context where governments are liquidity constrained. So another line of action that was mentioned was resilience for natural disasters. We have several modalities, from hurricanes and the typical natural disasters to pandemics. We recently developed and prototypes during the pandemic, but we also have the ambition to tackle more complex topics such as food security. The way in which we can address these topics and reach the scale on a regional level through these instruments can be very powerful and timely in this moment of vulnerability. However, there are many challenges ahead. We've all gone through them, and I think I want to focus on briefly on three. First of all is the human capital. Trying to build this human capital and trying to have governments absorb this technology in real time is riding a bike while you're fixing it. And I think the bank is making a lot of progress in becoming much more and more dynamic to be present on the ground, be conducting these engagements to be able to make progress on this technology transfer. The other thing is we've made a lot of progress on new clauses to these sovereign instruments that we've applied. For example, the hurricane clause that we launched last year gives flexibility and an agility to these instruments to be better tailored to each country context. So improving on that design, I think, is at the margin is important. And I want to end with a thought, maybe a wish or a vision that a lot of the questions that are facing, and this speaks to the last point that the Minister Cárdenas made about global public goods and being able to act at a regional level. And here, I think we as a multilateral institution, and this has been an ongoing debate, have to think about how can we move beyond the project and country straitjacket into a way where we can have regional, supranational instruments that are able to address these public goods constraint demand that we have, and address these topics that are beyond borders, such as food security, the energy crisis, and we have all the elements in place. We are the honest broker, we have flexible instruments, we are embedded and have a very good relationship with clients, and I think the question of leveraging all of these three very potent characteristics to be able to raise the bar in terms of our ambition in addressing these global problems is at the should be top of mind right now in our agenda. Thank you.
Muchas gracias, Susana, por esos
Thank you very much, Susana, for your comments, because they help us bring this down in terms of the IDB, saying that the IDB is part of the solution and will provide assistance to all governments and all countries in thinking about the reforms and implementing these reforms. So thank you very much for your comments. We ran over time, and we could go on talking about this fascinating topic. There are a lot of people connected on social media, so I'm very grateful for your participation and for your attention. It's quite a luxury to have this room full of people interested in this topic. And what we see is that, bearing in mind the interest, that there are hundreds of downloads of the book. Remember that we have the books in the Spanish, English, and Portuguese versions. And we also have some summaries, what we call the little DIAs. We have brief summaries for the people that are really busy, but that want to have the main ideas that you can draw from the book. So we also have that possibility. We'll see you in the country, so we will be presenting these main ideas in each one of the countries. We will be sending out a more specific message to each one of them, and the idea is to support the public and the private sectors, and you can count on the IDB to do that. The IDB wants to be part of improving the lives of all our citizens, and this is a contribution that I hope you have enjoyed in terms of this seminar, but also make the effort of reading the content of the book of this DIA, which is very good. Here we've spoken about a few things, but the content of the book goes beyond this discussion. So with that, I thank you very much for your attention. The people connected, we'll see you again in another event, and the people that are present here in Washington, to say thank you. I'm very grateful that you've come and that you followed our discussion. Thank you very much once again.